Thank you, Ruslan, and great to be back to Ukraine. When I first saw the headline for this panel, including the word liquidity, which I think has now been taken away, I was actually thinking that it's appropriate for the sovereign bonds, but in my view is not appropriate for the corporate bonds, because the corporate bond market globally, 99% of the corporate bonds issued are illiquid, full stop. They just don't trade in the secondary market. They perhaps, after issuance, trade for a week or two, where investors settle their positions depending on how much of their initial bid they achieved through the subscription. But what is more important, I think, is the primary market liquidity. And what I mean here is the repeat issuance. I think, the fact that the same issuers will come back with new issues, either tapping to the previous bond or issuing new bonds, and gradually, perhaps the bigger and better ones develop a yield curve for themselves. I think that is really what matters. And when we talk about terminology here, then obviously when we talk about corporate bonds, then the capital market terminology is such that it's any private sector bond, i.e. non-sovereign bond. So effectively 80% or even more of the global corporate bond market is in fact bank issuance. So banks are big players. The liquidity in the secondary market is only relevant for these bonds that are repo eligible, because you would normally issue bonds for long-term financing, and the long-term investors are usually pension funds and insurance companies, mostly life insurance companies. When I looked at the numbers here, the figures of the first panel, then I was thinking, how do I visualize the depth of the institutional investor base in Ukraine? And it doesn't look good, to be honest. Let me try to illustrate it for you. So what is that I have here? 30 hryvnias, correct. So this is what the pension funds have invested in the bond market of Ukraine per capita. So each of you has invested just about the euro. And if one of you invested 1,000 euros, that means the other 999 people didn't invest anything. So that's not very much, right? Unfortunately for the insurance market, I have only foreign currency because I couldn't get 165 hryvnia. So I have 5 euros is the amount that the insurance companies have invested in the bond market. That's not a lot. And I think there are several problems for it and the reasons why it's not happening. One is the confidence towards, I should call it towards the system, but it includes the capital market infrastructure. There was a previous panel here earlier talking about the trading and post-trading systems, the clearing and settlement, which I think is crucial to integrate properly and have one depository in place, and including also then the depository having links to the international market. So the CSD, either Clearstream or Euroclear or any other mechanism that then brings foreign investors to the market. It also, the confidence to the system includes legal system. And in Ukraine, the laws tend to amend themselves every now and then. So again, this month in September, there was a law draft 9035 being submitted to RADA, Securities Market Law Amendment, which has some positive elements like bondholders' rights, which we have been much supporting and helping to develop these clauses through technical assistance. It has certain elements for the hedging, which are relevant for the foreign investors. But whilst the law is in process of being changed, it's very difficult to act either as a serious investor into Ukraine or, in case of EBRD, to issue local currency bonds. So I would leave it at this for the time being.
Okay, thank you.